Welcome to a new episode of Trading Academy by Namrud. Today we will go over risk management. Our number one goal as stock options traders is to stay in the game as long as we can. This means not just making profitable trades, but also having the money to keep trading.
Take care, son. Try to stay alive.
To make this happen, we need to have a solid risk management plan. Experienced traders know that the market is unpredictable and can turn against us in a flash. So we really need a plan to protect our money and avoid big losses.
We should have a plan.
With a solid risk management plan, we can safely navigate the market and improve our chances of long-term success in stock option trading. Before you trade, think about how much money you have and how much risk you can handle. Only risk 1 or 2% of your account balance per trade. Stick to this method and your account won't suffer much from any bad trades. Traders can prevent major losses and save their trading capital for future ventures by risking only a small amount in each trade. This smart risk management move keeps our account safe. You really need to honor your stop loss when managing risk in your trades. Setting a stop loss is a key component of risk management, as it defines the point at which you will exit a trade to protect yourself from excessive losses.
You guys gotta stop losing.
For example, imagine you have just opened a trading account with an initial balance of $500. You can only risk 2% of your account balance per trade, which would be $10 in this scenario. So what does this mean for your trading strategy? Well, it will determine both your stop loss and trade size. With a risk of $10 per trade, your stop loss for each trade should be set at $10. This means that if the market moves against your trade and loses this amount, the trade will automatically close, limiting your loss to $10.
Right. Let's do the math.
Now, let's consider the trade size. If you want to trade a $25 contract, you have a couple of options. You can either trade one contract for $25 and set your stop loss at minus $10, or you can buy two contracts for $50 and set your stop loss at minus $5 for each.
Suddenly everything seems so easy.
If your stop loss is too tight, you might get stopped out too soon and miss out on potential profits. Instead of widening your stop loss, it's better to adjust your trade size. By reducing your position size, you can maintain an appropriate level of risk while giving your trades enough breathing room to potentially move in your favor.
Hey, that's great, but can we make it smaller?
Remember, the goal is not to avoid stop losses altogether, but to find the right balance between risk and reward in your trading strategy.
Go find the balance.
To succeed in trading, take as many trades as you can without going over your risk limits. Don't be scared to take on different positions as long as they fit your risk limits, but that doesn't mean you should jump into every trade. It's super important to have a well thought out strategy that considers how much risk you're willing to take, what you want to achieve financially, and what's going on in the market. Making trades without a clear plan is a recipe for disaster and losing money. It's also smart to keep some cash on hand to manage risks.
We're going to keep the cash box here for a while.
Make sure to always have 40% of your capital in cash, so you're prepared for any uncertainties. This practice helps you make the most of market opportunities and minimizes potential losses. Thank you for watching. If you like the content, please hit the like button and subscribe to get more.